There's a lot of noise when it comes to money and investing. Headlines, market predictions, stock tips, and social media experts telling you what to do. But real wealth is almost never built that way. Real wealth is built quietly, systematically, and over time. And the truth is, most people were never taught how investing actually works. Most people think investing is about picking stocks. It's not. It's about building a framework that allows wealth to compound over decades. And that's what this podcast is about. I'm Denise, and this is Private Wealth, The Edit. I spent my career managing money and investments for institutions and high net worth families. And over time, one thing's become very clear to me. The way sophisticated investors think about money is very different from what most people are taught, or not taught, but do. This podcast is about closing that gap. Each episode, I'll focus on what actually matters, cutting through complexity to bring clarity to how wealth is built. I'm here to give you an institutional edge, one private conversation at a time. Welcome back to The Edit. Before we jump into today's topic, let's take a quick look at the road we've already traveled on. So in episode 1, I introduced The Edit and the framework behind the entire series. Successful investing is not about finding the next stock, it's about building a system, a portfolio that works together. In episode 2, we talked about the secret sauce of investing, asset allocation, and this is the decision of how much you should own in stocks versus bonds and other investments. Professional investors spend far more time getting that mix right than they do trying to pick the next winning stock. In episode 3, we talked about time, your time horizon, and the quiet, extraordinary power of compounding. Time is the force that makes a portfolio grow. Today, we're going to discuss something that sits underneath all of those decisions and the last piece of our building blocks. That's risk, and it's the price of admission. And here's the truth. Most investors think they understand risk. Very few actually do. Most people think risk means losing money. Risk is uncertainty. It's the possibility that the outcome will be different from the one you expect. Sometimes that means losing money. Sometimes it means earning less than you need. And sometimes it means taking so little risk that you never reach your goal. Risk isn't the enemy, but it is the price of admission, so you better get comfortable with it. If you want to earn higher long-term returns that stocks have historically provided, you have to accept periods when stocks fall. There's no return without uncertainty. There's no risk without reward. The question is not whether you will encounter risk, because you will. The question is whether you're taking the right amount of risk and whether you're prepared for that risk and how it will feel like when the road gets rough. First, where are you going? So imagine you're getting in a car. Before you decide how fast to drive, you need to know where you're going. Are you driving 5 minutes to the store? Are you taking a leisurely stroll through the south of France? Are you late for a flight? So the destination changes the trip. Investing works the same way. Your destination is your financial goal. Your portfolio is the car, and risk is your speed. And your time horizon is actually how much road you have left. When you have decades of road ahead of you, you have more capacity to take more risk because you have time to recover from market setbacks. And as you get closer to your destination, you generally want to slow down a little bit because a crash near the end of your journey leaves you with much less time to recover. But a long time horizon gives you permission to take more risk. It doesn't mean you have to. And just as driving fast does not guarantee that you're going to arrive safely, taking more investment risk does not guarantee a higher return necessarily. It creates the potential for higher returns, but also for greater losses. The important point is that risk isn't something to avoid or fear. It's something to understand and control, like speed. You cannot answer how much risk should I take without also asking, what's the money for and when will I need it? So this brings us to another very important distinction in investing. Volatility and risk are not the same thing. Volatility is movement, the normal ups and downs of a market. And in our driving metaphor, volatility is the condition of the road. It may be smooth one day and bumpy the next. Risk, by contrast, is failing to reach your destination. If you're 30 years old and saving for retirement, a 20% market decline may feel terrible, but it's not really dangerous. You're still contributing, you have decades ahead of you, and lower prices even allow you to buy more shares. Now imagine that you're retiring next year or you're paying tuition now and need to begin withdrawing from that same portfolio. The identical 20% decline can have very different consequences. So the market movement is identical, but the risk is not. A bumpy road may be uncomfortable without preventing you from getting where you're going. What matters is whether the car, the driver, and the route were built to handle it. The speed limit is not 0. Many people respond to uncertainty by saying, fine, then I simply won't take any risk. But the investing speed limit is not 0. If you drive too fast, you can crash. If you drive too slow, you may never arrive. Cash, which is 0, can feel safe because the number on the statement doesn't move much. But inflation is quietly moving the destination further away. $1 today will not buy you the same amount 20 years from now. If your money grows more slowly than the cost of your life that you want, you're losing purchasing power, even though the account balance may never fall. So taking too little risk can be a risk all on its own. And this is the part many investors miss. They're so focused on avoiding a temporary market decline that they ignore the permanent risk of not funding retirement, outliving their assets, or being unable to maintain their lifestyle. Safety is not the absence of movement. Safety is having a reasonable route to the goal. How fast do you think you can drive? Everyone believes that they are an excellent driver on a sunny, empty highway. One of the biggest mistakes investors make is deciding that they have a high risk tolerance simply because markets have been rising. Everyone feels really comfortable with risk when their account balances just keep moving up and up and up in the same direction. The real test comes during a crisis. Think back to March 2020. Think back to the global financial crisis of 2008, 2009. Think about the dot-com collapse in early 2000. Those are the moments that reveal how fast you can really drive when it's dark, raining, and the road is covered in ice. I've spent nearly 30 years managing money through market cycles, and I've watched the same movie many times. An investor said she's comfortable with risk, and then the market falls 20%, and suddenly she's not. She sells. The market recovers, and she buys right back at a higher price. The car was not necessarily the problem. The plan was not calibrated to the driver. I want to spend a second on risk tolerance versus risk capacity. There are two separate questions here, and both matter. Risk tolerance is emotional. Risk capacity is financial. So risk tolerance asks, how much volatility can you live with without losing sleep or abandoning the plan? Risk capacity asks, how much loss can you financially live with or absorb without putting the goal at risk? You may emotionally dislike volatility, but having decades, strong cash flow, and more than enough assets to tolerate it financially is different. And the opposite may be true. You may enjoy taking risk. You may follow markets. You may listen to CNBC every morning and feel completely confident in what you're doing, but you may need the money soon and lack the financial capacity to recover from a large loss. So risk tolerance to me is emotional and risk capacity is financial. The right portfolio sits at the intersection of those two. What can you afford and what can you live with? It doesn't matter how fast the car can go if the driver panics at 60 miles an hour. And it doesn't matter how confident the driver feels if the road ends in a mile. And sometimes the biggest risk is really the driver. And that's really brings us to what we call behavioral risk. Panic, greed, FOMO, chasing performance, selling during downturns, and buying after rallies. I've seen more wealth damaged by poor decisions than by market crashes. The greatest risk isn't market volatility, it's investor behavior, and that's you. A market decline is often temporary. A panic decision can turn that temporary decline into a permanent loss. The perfect portfolio on a spreadsheet is useless if you cannot hold it in real life. And this is why the best allocation is not necessarily the one with the highest expected return. It's the one that gives you a strong chance of reaching your goal, that you can stay invested during difficult periods. Let's spend a moment on what professional investors do differently. large institutions do not spend their time trying to predict the next turn in the road. They don't know what's going to happen next year. Instead, they build portfolios designed to survive uncertainty. They diversify because one engine can fail. They stress test. They think in probabilities. And they maintain liquidity because even a great long-term investment can become a problem if you need to sell it at the wrong time. Most importantly, institutions create the rules before the crisis arrives. You do not want to decide how to handle a skid in the road when you're already spinning out. The perfect portfolio is not the one with the highest expected return. It's the one that you can hold through difficult periods. And here's where we get to the 25% test. And this is a simple exercise you can do today. How do you know what your risk tolerance is? Here's a great place to start. Imagine you wake up tomorrow morning and your investment portfolio is worth 25% less than it was yesterday. What would you actually do? If your honest answer is, I'd buy more. Your portfolio may be too conservative. If your honest answer is, I would sell everything, your portfolio may be too aggressive. And if your answer is, it would be uncomfortable, but I'd review my plan and stay invested, you may be closer to the right speed. The goal is not to feel nothing. A 25% decline should get your attention. That's a lot. The goal is to avoid making a decision that destroys the route to your destination. Key takeaways. Let's leave today's episode with 3 ideas. First, risk is not something to avoid. Risk is something to manage. Second, volatility and risk are not the same thing. Short-term market declines are often the price investors have to pay for long-term wealth creation. And third, the greatest investment risk is often your behavior. A good portfolio isn't one that only looks good during up markets. It's ones that keep you invested during the down markets. So let's turn now to our market edit for this week in a piece I call Gravity and the SpaceX IPO. And this is a great illustration of today's topic, risk. So SpaceX went public in June at $135 a share and quickly climbed as enthusiasm took over. The stock peaked at $225 a share, and then it precipitously fell from its post-IPO peak. At one point, the stock had lost roughly a third from its peak price. For a moment, it seemed to be behaving exactly like a rocket, up and to the right with gravity nowhere in sight. Then it came back down to earth. The company did not suddenly forget how to launch rockets. What changed was the price investors were willing to pay for a very exciting future. At its peak, investors weren't simply buying the SpaceX of today. The stock was aspirational. They were paying in advance for success, for successful Starship launches, for continued Starlink growth, for space-based AI infrastructure, and for years of ambitious planning unfolding largely as promised. The higher the expectation embedded in a stock price, the less room there is for disappointment. That's valuation risk, and it tends to be the hardest to see when a stock is rising. And that's the strange physics of investing. A great company can still be a risky investment if the expectations embedded in its price are too high. The higher the valuation, the more perfect the future needs to be. And any disappointment, slower growth, higher spending, more competition can bring gravity back into the equation. Excitement can lift a stock, but gravity reminds us that price still matters, valuations still matter. As SpaceX climbed from 135 to 225, it probably felt safer with every dollar it gained. The headlines were enthusiastic and the early investors were making a lot of money. And anyone sitting on the sidelines would probably wonder whether they missed the opportunity of a lifetime. I wasn't invested in the SpaceX IPO because I wasn't allowed to as an employee of a broker-dealer. My husband wasn't pleased about it and thought we missed the stock of the century. And this is where investor behavior becomes really important. We often feel most confident after an investment has just risen, and most frightened when it's fallen. In other words, our emotions can encourage us to buy when optimism is priced in at the top and sell after reality has become priced in when gravity sinks it lower. And this is precisely when the institutional investor will start to buy, when you panic and start to sell. And the lesson here isn't don't invest in SpaceX. The stock may recover and the company may ultimately deliver on its many ambitions. The lesson is that innovation does not repeal the laws of investing. Price matters, valuation matters, diversification matters, and the amount you invest matters. Rockets are designed to defy gravity. Investments are not. Innovation may be powerful, but gravity is undefeated. Sooner or later, even the most exciting investment can come back to fundamentals, must come back to fundamentals. And investors need to be sure that they can remain on board when it does. When a stock feels irresistible, ask yourself 3 questions. How much of the future is already priced in? How much could I lose if the story takes longer to unfold? And is this position large enough to change my financial destination? That's the market edit for today. And before I conclude, I want to introduce a new element to the website and the podcast. I call it the AI edit. And I will be including AI prompts that go along with the episode so that you can turn this episode into reality and start looking at your own financials and bringing it to life. In this episode, if it has you wondering how much are your risk tolerances, I've created a set of AI prompts to help you figure that out. Use them to discover your true risk tolerance, calculate your risk capacity, and give your portfolio a 25% test, because understanding your risk is really where the work begins. You can find the AI prompts on the website, privatewealthedit.com, under the episode. Take them, copy them into your favorite AI engine. I like Claude for this. I think it's great. And answer honestly and start turning today's conversation into your own personal risk framework. But just one word to the wise: please do not ever trade on anything that came out of a chatbot. Do not move money around. Take that information, it's educational, and then take it to your financial advisor, your wealth manager, and have a conversation. It's the perfect place to start. Next week, we'll be tackling a question everyone asks, always, eventually: do I have enough money to retire? So I will introduce a fabulous tool. It's called the Retirement Checkpoint. It's a simple way to see where you are today, given your age and annual earnings, and whether you're on track to retire. Because before your GPS can map this route that we've been talking about, this road, it needs one essential piece of information. Where are you now? Thank you for listening today. If you found this useful, follow the show or share it with someone who you think might find it interesting. Send it to your kids. If you have any questions that you'd like to ask or topics you'd like me to cover, please email me at privatewealthedit@gmail.com. And remember, I'm here to give you an institutional edge, one private conversation at a time. This podcast is for informational purposes only and does not constitute investment advice. All investing involves risk, and you should consult your own advisor before making financial decisions.